First to the big highlight, and this is bad news for the salaried class. Budget 2016 introduces tax on employee provident fund withdrawals, the tax on EPF withdrawal to impact lakhs of salaried workers. Now, tax on EPF superannuation withdrawals over 1.5 lakhs as well. So that has come as a bit of a bitter pill for most of the salaried people. Joining me now, Tapti Ghosh, a partner at Deloitte Haskins & Sells. Also, Divya Baweja, partner at Deloitte. Thank you so much for joining us. First to you, the question, Tapti. This is really a setback, isn't it? That's how people are looking at it right now. Because the first 5 years, you're already taxed. After 5 years, if you needed to withdraw, some money, say, to build a house or any emergency need, now out of that, 60% will be taxed.
That's correct. Definitely a setback. What we've been going through the fine print on this. The highlights talk about 40% of the corpus being exempt from tax, which means that the 60% would be taxable at the time of withdrawal. When you go through the fine print, what it also says is that it is the withdrawal of the contributions made from the employee's contribution that would be considered, taxable to the extent of 60%.
Right.
Now, this throws up a new dimension, and I'll ask Divya to add to it, because you see, when the employee earns the salary is taxable. He may or may not get an ATC deduction, depending on whether or not he has any other investments or expenses which are covered under ATC. Now, salary is already taxed. At the time of withdrawal, if the withdrawal quantum of the employee contribution, to the extent of employee contribution, is also taxed, then it could actually lead to a double taxation. So, you want to add to that?
So, as Tapti said, this is something which is totally spanner, I would say, which has been thrown. And when we talk about the employee contributing, he gets deduction under ATC, which is limited to 1,50,000. And so, in case that may include PF or may not include PF. And now what the fine print, when you look at it, when you look at the budget speech, actually, what came out was that 40% of the total accumulation would be exempt, balance would be taxable, to try and bring in parity with the national pension scheme or the superannuation scheme. But when we actually go through the fine print, it says that 40% of the amount contribution by an employee other than an excluded employee. So what is an excluded employee has not been defined. So I'm sure the purpose is that when they define excluded employee, they would look at certain category of employees who are earning certain level of income, that for them the exemption would be 100%, and for others it would be only 40%. So to that extent, yes, there is an issue of double taxation, and something, as you rightly said, people make investment, and earlier it was only up to 5 years. So now this would go beyond 5 years also going forward. Yeah,
that's right. I'm told we have some callers. Jyotirmay Guha joining us from Mumbai. Good evening, Jyotirmay. Go ahead. What do you want to say?
My question is, I got part answers, of course, through the discussion as it was going on. My question is, I'm returning on 31st, eventually in 31st March, and my withdrawal will obviously happen beyond 1st April 2016. So this tax deduction will happen from my PF accruals?
So if you're retiring on 31st March, what it talks about is any contribution made by an employee during 16-17. So if there is no such contribution, ordinarily the deduction should not happen. You should get the benefit. Yeah.
Okay. Thank you.
Thank you for joining us. We also have Mr. J.S. Kamath also joining us from Mumbai. Mr. Kamath, go ahead. What's your query?
My query is that I have been depositing in BPF as well as PF for last 35 years. And now all of a sudden, when it was EEE, now it says we will be taxing. Whether it will be retrospective taxation or it will be in future only. And if so, whether I can stop my BPF with immediate effect and go forward.
Captain, you want to take it?
Sure. So I don't think that the intention of the budget is to bring in an element of retrospectivity. We are only talking about going forward. As far as NPS is concerned, the benefit that is coming out of the budget is going to be, to a certain extent, retrospective. So that's good. But as far as the Provident Fund taxability is concerned on the corpus of which is built out of the employee contribution, no, that's not going to be retrospective. It's going to be only going forward with effect from 1st of April 2016.
Right.
So in that case, can I stop my VPF?
No, PPF will be on a separate, they don't talk about the public provident fund. What it talks about is only the employees' provident fund.
Okay, did you get that, Mr. Kamath?
I'm talking about my 40% of voluntary contribution, which I've been making for last so many years. Can I stop that right now?
And you're referring to the employee contribution to Provident Fund?
My contribution to Provident Fund, I'm putting in 40% of my basis towards the VPF, Voluntary Provident Fund.
Okay, as per law, what this is related to the Provident Fund Act and not related to the Tax Act. The law provides that there is a certain minimum contribution that will have to be made by the employer and the employee, and that's matched to the Provident Fund corpus. So that Provident Fund you cannot come away with.
Does that answer your question? Okay, we also have Mr. K. Kumar joining us from Bangalore. Mr. Kumar, go ahead. What do you want to ask?
Good evening.
Good evening.
The question, one part of the question, I think you have already answered. This tax, is it applicable only for future contributions after 1st of April? That is number one. Number two is like in case if I am making some additional contribution over and above what is required, 12.5%, that additional contribution also, I have not availed any income tax benefit because of the additional contribution. And that additional contribution also, when I withdraw, it will be subjected to this tax at the time of withdrawing.
Okay, did you get the question?
No.
He's saying additional contribution that he makes towards his Provident Fund from the time this new law comes in, that will also be taxed when he withdraws it? Is that the question?
No, one question is, like so far, whatever I have accumulated, that amount, whatever is there as on today in my balance, will that be taxable whenever I am going to withdraw after retirement? Number one. Number two is, there is an option beyond the 12.5%, there is an option for individual employee to contribute additional savings into the EPF account. This is a voluntary thing. You may or you may not contribute. So this voluntary amount also presently I am contributing. This voluntary amount also will be subjected to tax at the time of withdrawal, is the question.
So as far as the voluntary contribution that you are making in excess of 12%, that is anyway going to be taxed in your hands at the time the contribution is being made. This is employee contribution to Provident Fund. No, we're not talking about employer contribution to Provident Fund. So there will not be. Let me rephrase my answer. As far as the voluntary contribution that you are making to Provident Fund on a month-by-month basis, there will not be any additional deduction that is going to be allowed to you at the time of making the contribution. At the time of withdrawal, yes, given the fact that this would be a part of the 60% of the corpus which is accumulated out of your contribution at the time of withdrawal, yes, it would be taxed.
Right.
That will be taxable only what I am going to make future contributions. Am I correct?
That is only for future contributions, yes, that's right.
So whatever you have contributed till 31st March 2016, that will not be subjected to this 40% or 60% regime.
But whatever is beyond that will be taxed. Mr. Kumar, I hope we got your queries. Thank you so much for joining us. We also have Leena Chatterjee Basu joining us from Kolkata. Good evening. Go ahead. What do you want to ask?
Good evening. No, you see, this imposition of income tax on 60% of the provident fund, well, it is not a welcome move at all. First, remember that employees who draw total of 15,000 only in terms of basic and DA are within the PF coverage. Employees in the higher bracket are excluded employees, as we know. And anyway, they are out of the PF set. See, by imposing income tax on provident fund, the government is targeting the lowest strata of the working class. It will pay to the senior fund workers, most of whom for most whom this is the only means of saving.
Okay.
And when they retire, they depend on the other hand, we see, hello?
Yes, yes.
On the other hand, we see that the government has allocated 1,000 crores to pay provident fund for new employees on behalf of, for 3 years on behalf of the employers. So what is the government trying to do? Take on the burden of the employers, at the same time taxing the employees. This is what I don't understand.
Yeah, certainly. Thank you so much for joining us here on the show. That was your comment. With that, time for us to go into a short break. But keep those calls coming. We have tax experts here, and we'll get your queries answered.